Okay, as everybody's getting into the room, I'll go ahead and kick us off. Welcome to day 2 of week 7 of the Elevate AEC experience. We are in the final stretch here, and today we've got an excellent session. I'm delighted to welcome Ed Renenger. He's the president and CEO of SES ESOP Strategies, a Stevens and Lee Griffin affiliated company. He's also the co-chair of Stephen and Lee's ESOP group and its employee benefits and executive compensation group. He concentrates his practice in helping companies navigate the complexities of ESOPs. And he's here today to talk about the benefits of ESOPs and if employee ownership is right for your firm. So welcome, Ed. Thank you so much for being here.
Thank you, Chad. Very, very gracious of you to welcome us. And with me, I have Clayton Bubeck, who is the president of Ritu, an engineering firm that's headquartered in Pennsylvania, but does work throughout the country. And a little later on, I'll let Clayton introduce Ritu a little bit and actually kind of tell the Ritu story because they fairly recently went through a fairly significant transaction involving an ESOP. So we thought it would be helpful for those who are here attending this session to have access to someone who's kind of lived through this and can give you kind of the inside perspective rather than just having someone like myself lecturing at you and trying to describe whether an ESOP would make sense for you. Better to bring it to the source. So I think I'm going to start it off by giving a very high level overview about what an ESOP is and how it's designed to work and how we see it play for AEC firms out there. Before we do that, I wanted to remind everyone that you can ask questions during this session. And I personally prefer doing these sessions live in front of real people so I can see facial expressions. I can participate, in a dialogue with people, and it's very, very difficult to replicate that online, as I'm sure you've seen over the course of several weeks at this conference so far. So I would encourage you, one way we can try to bridge that gap is encourage you all to try to ask questions. If you click the Q&A box, you are able to ask questions there. Clayton's going to help me try to navigate through all those questions in such a way that we can try to get to everything that's asked. Well, if they're applicable to where we are in the presentation, I'll weave them in as we go through the presentation. If not, then we can kind of answer a whole bunch of those at the end. So again, I encourage you to use the Q&A feature at the bottom of your screen. So with that as background, I'm going to go ahead and dive right in and talk to you a little bit about what an ESOP is and high level, how it's designed to work. So this is one slide I like to spend a few minutes on when we're actually talking to owners of AEC firms or even other companies that are considering an ESOP. And what it does is it really outlines various different ways that you can transition ownership of a business from gifting, in other words, actually giving the business away, to doing what's called an initial public offering on the right. So from left to right, as you see on your screen, those are 7 different ways that you can transition your business or the ownership of your business. And what we did is we saw part of this slide. We saw the top part of the slide, the names across the top, as well as the first row there that we labeled cash consideration at a conference we went to one time. I think it was done by the Exit Planning Institute. What I found fascinating when I was watching the presentation about that is from their perspective, everything that they were focused on was what they called consideration. Just this one line, just that cash consideration line is all that they cared about. So when I was listening, it occurred to me that cash consideration is not the only thing that matters to firms. There's culture that lives at firms right now that has made them successful. There are other value drivers that the ownership team may care about when they're thinking about how they transition their business. So what we decided to do was to build out this slide and to add to it a whole bunch of other value drivers that we find when we're talking to business owners and when we're talking to the key management team at a business. And some of those value drivers we hear from people are things such as, I would like to reward my employees. I want to maintain the legacy we have at our firm so that it can continue into perpetuity if possible. I would like to maintain the culture that we built up over time at our firm. So when I hear someone talking to me with things such as that, my immediate response is an ESOP might be a good fit. So what we did is we built out this slide a little bit to show some of those other value drivers. And when you're looking at this slide, I think an easy way to think about it is that if something's green, it tends to be really good at that. For example, if you want to maintain family control, gifting the business or selling it to the family is a good way to do that. But you're not going to get nearly as much money doing that as if you sell it to a third party. And so where an ESOP plays really well are things like rewarding management, aligning your management team with the long-term growth of the firm, rewarding your employees, minimizing cultural disruption, maintaining the legacy. Even community is one that we don't have on here that we hear from a lot of our clients that are looking at an ESOP. They go, I'm worried about maintaining the connections in the community. And so when I hear that, I think an ESOP is usually a good fit. What does that mean from a cash perspective, from the value of the business? Usually what we say is that it's a very similar value from doing an ESOP transaction as you might have from selling to a third party. And that's going to be very company specific. But a lot of times when we're working with AEC firms, what we find is that the professionals, your assets, if you will, those people who work for the firm on a daily basis, a lot of times they do not have non-competes. They may not already have some form of management incentive plan that keeps them tied up. And so a buyer, a third-party buyer often will look at that and say, hey, listen, I'm worried that your assets, your professionals can walk out the door if you were to sell your business to another strategic firm. And so what that has a tendency to do is in a third-party sale sometimes, and this is again very client-specific, but that can depress value in such a way that an ESOP doesn't have those concerns because you're not bringing in a new third party who's really going to change how you run the firm. So an ESOP lets you continue to run the firm as you always did, which makes it much more likely you're going to retain those professionals and therefore kind of minimize that depressed pricing you might get from a third party. So anyway, this is just kind of an introductory slide to give you again, kind of where we see an ESOP is, playing really well. But what I haven't told you at all yet is, well, what is an ESOP? I've been talking to you about the benefits of an ESOP. I've been talking about what an ESOP does do, how it's different than other types of transitions. So let me tell you very briefly what an ESOP is. Then I'm going to ask Clayton to speak a little bit about Ritu and kind of why they went down this process and ended up where they are. So for that, I'm going to skip forward a couple of slides here. But an ESOP it's a type of a retirement plan, actually. So a lot of you work for firms right now or run or own firms that usually have some sort of a retirement plan. It might be a 401k plan, you might have a profit sharing plan, you might even have an old traditional pension plan. An ESOP is another type of a retirement plan. But where it's very unique compared to other types of retirement plans is it actually, by law, is required to invest primarily in employer securities. So because of that, Congress created this ESOP structure that tells you that, hey, listen, we want you, business owners, current owners of the various firms, we want you to sell your company to an ESOP. And we're going to give you huge tax benefits to do that. And I'm going to talk about some of those tax benefits a little later on. But again, Congress put this structure in place specifically to say, we're going to give you huge tax benefits to utilize this type of a retirement plan called an ESOP, which is a vehicle that allows you to sell your firm to your employees effectively. These are not new things. They've been around a long time. Congress actually put it in place in 1974. As I mentioned, there are a lot of tax benefits, and I will talk about some of those tax benefits a little later on. So if you have any questions on those specifically, hold those until we get there. But like a 401k plan, the way it's structured is that this ESOP buys the stock of the company, and it can be some of the company, it can be most of the company, it can be all of the firm. So it buys the stock, and what it does is it slowly then gives that company over time to the rest of the employees in the firm, so that over time they become the owners of the firm without needing to bring to the table their own capital. And the way we finance it typically is we actually borrow money from a bank. Sometimes we borrow money from the sellers themselves, and we'll bundle that together and we'll use that as a way to pay the prior owners for this ESOP transition. So I'm going to pause for a minute here. I've been talking a lot. What I want to do is I want to turn it over to Clayton to let him tell you a little bit about Ritu and a little bit about the process they went through to implement the ESOP at their firm. Clayton.
Thank you, Ed, and welcome everybody. I'm glad everybody can join us today. So Ritu Associates, we are a 350-person civil engineering firm focused primarily in the Mid-Atlantic states, offices I have to Colorado. And last year, the year that we became 100% ESOP was actually our 50th year in existence. So it was a big year for Ritu, celebrating our 50th anniversary and becoming 100% ESOP. But how did we get there, like Ed said? So prior to myself being in leadership, George Ritu, our founder, who just after 50 years is no longer with the firm, he started looking at how was he going to transition this firm and keep his legacy. And Ed's slide a couple minutes ago, I didn't realize how many of the things that Ed went through with the ownership transition options were actually things that Ritu talked about and ended up deciding on an ESOP. So back to where we were, George Ritu, years before I got into leadership, said, I really need to transition the firm. He started selling shares to internal staff members, bringing them on as small shareholders. Realized that that wasn't fast enough to get him out, and there just wasn't enough value to be gained through those internal shareholders. So at first he went 10% ESOP. Then 5 years later, we went to a 30% ESOP, and we sat there for quite some time. So at this point, 30% of our company was owned by the ESOP, and George Ritu owned about 40%, and 20 of us owned the other 40% of the firm. We're at the point now, we're looking at how do we transition the entire firm away from our founder, Hank Ritu. So we're trying to look at how we do that. And we ended up calling in a couple of consultants from across the United States. SES Advisors was one of them. And since we were a 30% ESOP already, we weren't acting like an ESOP firm. Our founder really was utilizing that just as a transition vehicle. And he really missed out on what the ESOP is about. And I'm sure Ed will talk a little bit more about that later and the real value of it. But the existing 20 shareholders said, absolutely, we don't want to become 100% ESOP. Let's get people in here to tell us what's the best way that we can transition. So like I said, we had 4 or 5 actually consultants from across the United States come in and give us presentations. And it was amazing that most of them were just trying to sell a specific type of thing. Some said you have to use synthetic equity and that's the way you should sell this out. Others say you have to do this. One was saying you should go towards an IPO. And SES Advisors came in and looked at us and said, you know what? We don't know what's best for you. So we're going to look at all of these options. And we said, okay, but we don't want to be an ESOP. And he said, well, we're going to look at that as one of the other options because it is one of the major transition options that are on the table. So we're going to look at employee buyout, lots of different things. And after the entire evaluation was done, we were really blown away. And I actually remember Ed called the senior leadership team and said, I need to talk to you about something before we present this draft report. The ESOP really heads and shoulders in your situation is the best option for you. So let us come in and talk about it. We said, well, Ed, we don't want to do an ESOP. He said, well, just keep an open mind, please. And honestly, came in, went over what the ESOP was and what it would do for us and the company in the long term. Because like Ed was talking about in the value drivers, we were trying to figure out how to make our founder as happy as possible through the transition, how to make the 20 existing shareholders who were still there in the best position they could through the transition. We were already a 30% ESOP, so how did we treat this ESOP fairly in this transition? And we still had a company that we wanted to maintain the culture and the legacy of who Ritu Associates was. And as we started putting all those things on the table and saying we need to meet all of these, by and large, the ESOP was the best for us. It met all of those criteria and even exceeded a lot. Since that point, and we've, like I said, last year, 2019 is when we became 100% ESOP. We've formed a much stronger employee ownership committee. We're talking about not only the financial benefits of the ESOP and what it means to Ritu Associates, but really culturally, what it means that all of our employee owners are now thinking as employee owners. You know, when we were a 30% ESOP, we really didn't feel like an ESOP. But now that we're 100%, when I present to the company quarterly on what we call the State of Ritu, I talk about our employee owners. I talk about how I, as the president, I work for them now. And it really has changed the way the people at Ritu are looking at their jobs. They're not just coming to work and punching a clock and doing what they have to do. You actually see people talking about, what can we do to help the company do way better? From rank and file employees just sending an email someday saying, hey, I was thinking about it. If we plot this way instead of that way, I'll bet you we could save this much money. And that'll make our ESOP go up, right? And there's nothing that you can look at more valuable than when your employees are really getting around the idea of, how do we become part of our company to make us all better? Now, I don't want to push aside how much this culture means to us, but Ed's going to talk about, I'm sure, more about financially what it's meant. And financially, the ESOP has done some really positive things. And we were 30% ESOP for a while, but now it's 100%. We're just now starting to see and understand the full benefits of what this ESOP is doing for us. We had some built-in gains tax to pay when we transferred over from the firm we were to the firm we are. That's about to go away. So we're realizing next year, as our profits come in, we won't have to do that tax planning at the end of the year to minimize our tax liability. And there's just a bunch of other things that, again, that we are starting to see as really tremendous benefits to Ritu as a company. And also benefits, I'm very fortunate to get out and talk to a lot of leaders of other firms, like I'm sure a lot of you are. And as we talk to other ESOP firms that are farther along in their journey as being an ESOP, you really get to see the next steps that we're looking forward to and we're starting to plan for. And it's pretty awesome. So Ed, I hope that's enough to quick give a background of Ritu. To be simplistic, I don't want to take much time because I know there's a lot to go through. Anything else you'd like me to talk about with Ritu?
No, that's perfect, Clayton. I really, really appreciate that background and that introduction. Yeah, it's an interesting comment. That process you went through where you really didn't know what the right solution was. And that's something we see a lot of times with professional services firms, architecture and engineering firms in particular. It's a common thing, right? And oh, by the way, I didn't even mention this, but when you look at industry concentration of ESOPs across all companies, right? When you're looking at transportation or when you're looking at manufacturing, AEC, the highest concentration throughout the country of ESOP companies is in the AEC space. And part of the reason for that is because it's the way professional services firms generally get to be transitioned is you try to do it from one generation to another. And you have a very intelligent workforce, highly educated, who want to understand everything that's going on. And when you start looking at all the mechanisms that really facilitate paying fair value to the founder or founder family, and kind of how you can do that in a way that creates value for everyone, the ESOP plays really well in that space. And that's exactly what you went through too, right? Even though there was some psychological bias against it in the beginning because it wasn't really communicated effectively, it didn't become part of the culture originally, right? Getting over that bias really opened up a horizon for you. So anyway, Clayton, really appreciate you throwing out that experience. And I'll throw some questions over to you every once in a while as I go through here that I think might be relevant to those on the call. By the way, remind everyone, please ask questions. I got to talk an entire hour here, so every question that comes in means one less thing I have to think about. So in any event, I'm going to start digging in here to a little bit of the technicals of the ESOP. I had this one slide up here while Clayton was talking, so I'm sure you've already looked over that yourself. Bottom line is the number of ESOPs have stayed fairly stable throughout the last decade or so, although the number of employees that are at ESOP companies has gone up quite substantially over the same period. So ESOP companies are getting bigger and bigger. Part of that is that they tend to cash flow a little better, so it's easier for them to grow. So I'm going to go ahead and move forward. By the way, I can send this presentation out to anyone who wants a copy of it. I can send it in PDF. There are several slides in here that I do not intend to go into much detail, but you're more than welcome to obviously read it on your own and spend some time with it. So I encourage you, if you want a copy, just shoot me an email. Shoot myself or someone at Zweig an email, and we will make sure we get you a copy of it, okay? So we've talked a little bit about what an ESOP is, and what I would like to do is go through a couple pieces of mythology here, because there definitely is some confusion in the general marketplace about what an ESOP is designed to do and what it may not do well. And that mythology sometimes I find when I'm talking to people who are considering an ESOP tends to be one of the biggest hurdles in getting a successful transaction done. Because if you have a misperception in your head around what an ESOP can and can't do, then what can happen a lot of times is you don't even consider it. You don't really look at it as a viable alternative because your perception of what's possible is wrong. So you don't even explore that pathway. So I like to break down some of that mythology a little bit. And so at least an ESOP is a viable alternative when you're considering a type of a business transition. So one is this concept of value. How valuable is it if I sell my business to my employees through an ESOP rather than selling to a third party? And there can be this perception out there that you're giving the business away, that you're not getting paid fair value. That is all completely not true. It's true your employees are not bringing cash on their own. We're funding it with future cash flow from the business, but nothing is being given away. Instead, what's happening is that the owner is getting paid fair value. There's this defined term, adequate consideration, which is utilized in the ESOP community, the law says about. So that basically is fair market value between willing buyer and willing seller as determined by an independent appraiser. And so as long as we can get fair market value, the concept is that we can get fair value into the owner's hands so that you're not really giving away the business.
Ed.
Yes.
Question came up. Is that valuation the same if you're only going partial ESOP, assuming a 25%? Is it still the same fair market value or is it different?
Oh, excellent question, Clayton. Yeah, to whoever asked that, I appreciate it. So a partial ESOP means we're selling less than 100% of the company. So the most common strategy if we're doing a partial ESOP is we're selling maybe 20, 25, maybe 30, maybe 40% of the company to the ESOP. In that scenario, the ESOP is a minority owner and minority shares are not worth as much as control. The discount we typically see for a minority share of stock is a 10% discount to traditional fair value. So there is a discount, but it's not nearly as large as you might think it is if you were doing some sort of estate planning tool where you often see discounts in the neighborhood of 25, 30, or maybe even 40% for a minority share. But there is a discount. About 10% is kind of what the going rate is in the ESOP community. Great question. Well timed. So some other mythology is that, well, if I sell my business to an ESOP, then that means my employees as the quote owners, they can see everything that's going on. They can see all the books, records, financial statements. That is actually not the case. Even though we talk conceptually and colloquially that the ESOP employees, the participants in the ESOP are the owners, they actually do not own the stock directly. So they are not technically shareholders. Instead, the trust, this retirement plan's trust that we set up, the ESOP trust is the owner of record. And so the trustee, whoever that is, has the right to see that information, but your employees do not. There's no legal right for them to have access to that information. Now, I will tell you, some companies choose to start sharing more information. They move, on a scale of completely closed book to completely open book management. What we see is that companies will kind of move toward open book, maybe not all the way, but they'll start moving in that direction. And my experience has been that they do it slowly over time. And if you do that right, and you try to educate your employees about what leads to profitability at the bottom line, they start getting it slowly over time, and they start making informed decisions that have a real impact on the value of the company over time. Clayton, have you seen that at Ritu?
That's exactly what we've been doing at Ritu. And we start not opening up the books like you said, but really starting with a higher level, understanding where profitability comes from, and then showing them how we are making profit within the company and how that profit affects them. We talk about in our case, we talked about when we did the ESOP buy and we took 70% of the value of the company into debt. So our equity went down. So our share value, of course, went down. Actually, not 1-for-1. It only went down around 50% in our case. But we're showing them also, as we work and we pay off this ESOP debt, how our share value is coming up. So our share value in their ESOPs accounts are increasing, and they understand this both by the paying off of the debt and by how well we do as a company because of the hard work they put in. So it's that double whammy at that point in our case as we're paying debt down. And we talk about that a lot, both again, quarterly at the State of Ritu, and we put out emails to the whole company with our financials behind it to talk about how this is going.
Great. Thank you, Clayton. So another one is this concept of I'm losing control if I sell my business to the ESOP. And that on one level, that's true. If you're selling 100% of the company to the ESOP, you don't own it anymore. So you don't get to make all of the decisions anymore. On the other hand, if you're selling a minority stake, something less than 50, you could still control the business. Now that's going to depend whether you're the only shareholder left or whether you have a more diverse shareholder base like Clayton did at Ritu. But the bottom line is you can't actually have real control by selling less than a majority stake. But even if you sell 100% of the business, don't forget that companies are run via a combination of their board of directors and their management team. And that's true for non-ESOP owned companies, that's true for publicly traded companies, and that's also true for ESOP owned companies. So what we like to do when we transition to an ESOP form of ownership, if you don't have it already, is to get a good, robust board and management structure in place that can facilitate good corporate governance. So the idea is that the trustee should not be involved, and candidly never is involved in the day-to-day administration of the company. They shouldn't be. That's not what they're good at. They're good at being a trustee of an ESOP. They're not good at being the owner of an architecture or an engineering or a construction firm. That's not what they do. So another mythology is that it's very expensive to set an ESOP up. I laugh at this one a little bit because on one level it is. It does cost real money to get the ESOP done. I'm sure I won't ask Clayton to tell you if that's the case, but I'm sure he would tell you it was in their case. But the reality is it's really not any more expensive to do that than it is to sell to a third party. Anytime you're selling the business, it's a material event in the life cycle of a firm. And it should be expensive because you want it done right and you want it done in such a way that you're protecting risk for all the parties. But an ESOP is really no more expensive than anything else. The other thing I'll tell you is that when it comes to ESOPs, because of the tax efficiencies you have to running an ESOP, and I'll get into some of that detail a little later on, the truth is those transaction expenses are paid for within the first year, maybe a worst case scenario, first 2 years of running as an ESOP company. So I think someone, go ahead, Clayton.
And so we did get a question in the chat asking, what can you anticipate as the regulatory / administrative costs to operate on an ESOP? And I'll move that into the questions.
Great,
also.
yeah. So good question. You do need to consider the fact that you're running a retirement plan, and there are certain rules around how you have to run that retirement plan that do have some ongoing annual burdens to running the ESOP. Depends on how big the company is, because obviously risk is correlated with size from an operation standpoint. But for the most part, you're probably looking at a total annual administrative burden of running the ESOP of somewhere in the neighborhood of $50,000 to $75,000 is a good rule of thumb. And that's going to cover the cost to pay for a third-party administrator, the firm who actually keeps the records of the ESOP. It's going to be your expense to pay for a third-party trustee if you choose to have a third party, and most companies do. The other is that you do need to have an annual appraisal done. So when you add all of that up, 40, 50 at the low end, up to maybe 75 is what I usually see on an annualized basis. Now, the corollary of that is that if you do an ESOP correctly, at some point, either right when you're done with your transaction or within, at worst case scenario, 5 years after you do the transaction, what you end up with is a company that is 100% operationally tax-free. So that's one of the tax benefits I will talk about and kind of show you why that's the case a little later on. But when you think about how beneficial that is, that you don't need to make tax distributions anymore to your shareholders in a 100% ESOP company, those costs are effectively being picked up by the federal government. So moving on here, I'm going to talk briefly about two broad types of ESOPs. One that we call a non-leveraged ESOP, which means there's no debt that we're borrowing to finance the transaction. And the other is what we call a leveraged transaction, where we're actually borrowing money from a third party to facilitate the transaction. And in that case, it allows for a lot more cash and liquidity up front. It is by far and away the more common ESOP transaction, a leveraged ESOP transaction.
I'm sorry.
Very rare to see non-leveraged.
Could I jump in with a question before we get into the leverage and non-leverage?
Please, Clayton. Yep.
We have a question come in. that asks, we've heard that the trustee may need to be a licensed professional, architect or engineer, perhaps in certain states. Are ESOP for architects now recognized in all states? Do you mind if I jump on that one? Because
Please
we
go
have.
ahead, Clayton.
So, Mr. Lehman, that's a great question because Ritu ran into that exact issue. We were looking always to use the third-party trustee for our ESOP. We felt that that was the most fiscally positive thing to do and move forward, really to look after the ESOP trust. However, there are a few states within the United States that say that the owner of a company, which now becomes the trustee, must be a licensed professional in that state. So now I am our ESOP trustee along with our COO, but we have a special valuation fiduciary that is the third-party trustee that we were always going to hire that oversees the valuation portion of our ESOP. So the biggest issue when doing an ESOP is making sure the valuation is done right. So we let all of that be done by this special valuation fiduciary, and they cannot be called trustee. They cannot be called co-trustee. The two states that we were trying to get licensed in would not allow that. So that's how we set it up. So we have two internal trustees that are licensed in the states that required it, but we do have this special valuation fiduciary, which does the job of the trustee. I hope that answered the question, Mr. Lehman, but that's all the question.
Yeah, and it is an excellent question, and I'm glad it was asked because every state is different, and every state's different for architecture licensing, and every state's different for construction licensing. And so it's really important that that you work very carefully with whoever you work with on your licensing generally, and whatever ESOP consultant you go to work with, that you make sure they understand those licensing requirements, because every state is different. New York is very weird for ESOPs when it comes to architecture. North Carolina is very weird for engineering. And every state has their own rules. So knowing what those rules are and navigating them is really important. Great question. So a third type of ESOP is what we call blended, where we will not borrow money initially, but at some point we will convert to borrowing some money. So I want to briefly show you the cash flows on how ESOPs work, because it's a good way to describe some of those tax benefits. I'm going to skip a slide here, and what I'm going to do is I'm going to jump a couple slides forward here, and I'm going to actually show you the mechanics of a non-leveraged ESOP here. And I see I have a mistake on this slide here already in our graphics. But in any event, in the non-leveraged ESOP, we have three parties. We have the company, we have the shareholders, and we have an ESOP trust. So what happens in a non-leveraged ESOP is, on an annual basis, what happens is the company will contribute, usually cash, although you're allowed to contribute stock, but they'll contribute to this ESOP trust, this separate trust that's created that's really separate and distinct from the company. That cash then goes into participant accounts. And then what happens is, over time, as we've built up cash in the trust, the ESOP will go out to the shareholders and it will buy stock from the shareholders in exchange for the cash. So the company, by contributing cash to the trust, it can use that same cash to ultimately buy stock. Well, why is that beneficial? What's going on here that makes it valuable for the company? The real beauty of this structure at the end of the day is when a company contributes something to its retirement plan, that is tax deductible to the company. So if, for example, the company makes a $500,000 contribution to the ESOP, it receives a deduction for $500,000. So even though $500,000 in cash went in, it really only cost the company, from a tax perspective, say $300,000, or they're going to get a deduction that's going to generate $200,000 in tax savings, if you will, by utilizing this ESOP trust. And so that $500,000 that's then used to buy stock from the shareholders didn't really have the same cost from a tax perspective. So it's very efficient to utilize that structure. Now, this is slow. If you're going to do this over a period of time, it takes the shareholders a long time to get all of their money. So it's not a structure we use for a lot of our ESOP transactions. So what I'm going to do now is I'm going to flip forward a couple slides, and I'm going to show you how this works in a leveraged ESOP. And I'm going to preface this by saying that every single deal we do is different. This is one common structure. Clayton's structure, Ritu, was radically different than this. It was much more complicated because we had 23 shareholders we were dealing with. We also had the engineering firm that was partially owned by the ESOP, but Ritu actually had another entity that was owned by a lot of the same shareholders, but not all the same shareholders, that was not providing any licensed services. And what we did is when we did the whole transaction, we brought it together under a holding company so that we created this new structure. So there were a lot of moving parts in that transaction. That's not the norm, right? So what I'm going to show is a fairly simple transaction. So in this case, we've only added one party to this dynamic, a lender, but a lot more complexity. So what happens is the company itself, not the ESOP first, but the company will actually borrow cash from a lender. And in this example, let's assume that the company is worth $10 million in this hypothetical, okay? So the bank is going to loan $10 million to the company. The company will then turn around in step 2 and loan that same exact $10 million down to the ESOP. So 2 different loans. We have one with the bank, and then we have another one with the ESOP. We call this one, the ESOP one, the internal loan, the ESOP loan, and then we have the actual real debt with the bank, the external loan in step 1. So now we have $10 million in the ESOP. What happens is the ESOP will take that $10 million, it will buy stock from the shareholders for $10 million. So now the shareholders received their full $10 million on day 1. The trust now owes $10 million, but it also owns $10 million worth of stock. But because it owes $10 million in debt, what it does is it takes all of that stock and it sets it aside in a special suspense account, the special account in the ESOP. The employees don't have anything yet. They get nothing. So that all happens on day 1. Now we've set the ESOP up. Here's what happens on an annual basis. Every year, the company will contribute, and let's assume we had a 10-year term on this loan, on this whole debt package. So we're paying this off over a 10-year period of time. So that's basically, I need to pay $1 million a year in principal plus some interest every year. So what will happen is the ESOP the company will make a contribution to the ESOP that's fully tax deductible, that $1 million plus interest. The ESOP turns around on the same exact day and it will make a loan payment back to the company. So that $1 million plus interest goes in a circle, but that's generated a tax deduction for the company. What happens also once I do that tax deduction is shares are released from that special suspense account I talked about earlier, and they actually go into participant accounts. So slowly the employees earn, if you will, the company by the company paying down its debt. Now the company gets its $1 million back from the ESOP and it makes its debt payment out to the lender. So the cash does go to the bank ultimately, but that whole process converted that $1 million on an annual basis into a deductible contribution by utilizing the ESOP. That deduction is valuable, whether I have an S corporation or whether I have a C corporation. But if I have an S corporation, the tax benefit is even larger than that, because as most of you know, when you have an S corporation, every shareholder is responsible for paying their taxes on their proportionate part of it. And you probably go through this for many of your firms right now. You probably issue K-1s out to your shareholders. They get those K-1s. They have to file them on their own tax return. The company is probably making a tax distribution out to the shareholders so that they have enough cash to pay their taxes. It's a very cumbersome and expensive process because of all that hassle of doing all those tax returns. If an ESOP owns, say, 30% of your firm, it's entitled to a tax distribution as well, just like all your other shareholders are. So it gets its tax distribution, but it doesn't have to pay tax. It is legally a tax-exempt trust for federal and state purposes in every single state in this country. So when it gets its tax distribution, it can use those tax dollars to make a loan payment to the company. So dollar for dollar, money that would have gone to the federal government in the past, that would have been used to pay taxes by making tax distributions to your shareholders, instead can be used by the ESOP to make payments on your debt. So just imagine how tax efficient that is. And keep that in the back of your mind when you think about the ongoing costs of running the ESOP and the costs of setting up the ESOP. So the government in many ways is picking up all of those costs and then some because of those tax shields we get put in place. So I'm going to pause here very briefly. Clayton, anything you want to point out here? Anything that seems off to you, or anything from your own experience that you think might be helpful?
Well, one of the interesting things is I know as goes through it, it gets a little confusing of why does the company give the ESOP money and then the ESOP money gives it right back. Once you understand, like Ed said, the mechanics of why you're doing it, it's really not as confusing as it sounds. It is really the way that the ESOP gets money. And the way I always sort of explain it to our ESOP participants is essentially it's how the company is paying the ESOP to allow the ESOP to release that amount of shares. So you release the amount of shares either equal to what you've paid off, or you can put something else in place to release those shares slower than what you paid off in that debt, depending on how you want to manage the shares that go out to the participants. And that's something that you can work with your advisor on, because there's different, again, I've talked to 10, 15 different ESOP companies. Everyone looks at that differently and has what's most important to their company. But it's about getting those shares into the hands of your now employee owners and making them think like an ESOP.
Perfect. Thank you, Clayton. Yes. So again, I am going to go ahead and skip some slides here and keep moving. So another thing I often get asked is, well, what does it cost? How long does it take, if you will, to put an ESOP in place?
And this is a quick question on that.
Sure.
That came. Are lenders willing to loan 100% of the company in one loan?
The short answer is it depends on who the lender is. If we're talking about a bank, the answer is absolutely not, because banks only loan, say 2 to 3 times what your what we call EBITDA, which is a standard metric we use to measure how profitable a business is, which stands for earnings before interest, taxes, depreciation, and amortization. So if a normal A&E firm is worth, say, 6 times EBITDA, and that is, by the way, completely firm specific. So do not assume that that's what your company is worth. But if a firm does trade at, say, 6 times, and some are more, by the way, and some might be a little less, but if a firm is worth, say, 6 times EBITDA, and a bank is willing to loan, say, 2 to 3 times EBITDA, that leaves a gap. And so the question is, well, how do we finance that gap? The way we do it is we take part of it from the bank. So maybe the bank, let's just use my $10 million example again, right? And let's just, for the sake of argument, assume that they were $2 million worth of EBITDA and they traded, say, 5 times EBITDA. So 5 times 2 is 10. It's just simple math, right? And we have a lender who's willing to loan 2 times EBITDA. So they come in and they say, hey, listen, we're going to give you a check for $4 million on day one. That still, in my example, leaves a hole for $6 million. The question is, where does the $6 million come from?
And this is the money that the company is looking to give the shareholders, correct, Ed?
Correct,
so people want their $10 million to sell the company.
Right. And so what we do, we give $4 million of it on day one to the shareholders, but we also then give the shareholders a note. We give them a loan, basically, that says, hey, listen, we promise we're going to pay you an additional $6 million after we've paid the bank their $4 million. So if you're doing a 100% transaction, that's usually how we'll finance it. Part of it with bank debt, and then part of it by telling the shareholders that they're going to get paid at a later point in time.
Loan, in that case, Ed, does someone need to personally guarantee that loan?
Clayton, did anyone provide a personal guarantee at Retu?
They did not at Retu.
Nope.
And we did 70%.
Yeah, you did 70, but I mean 70% of the value of the company, and I forget, and that we wouldn't want to share that with the whole world anyway, but we got well over 2 times EBITDA, I think, on the senior debt. But the truth is that for most ESOP transactions, the selling shareholders do not need to provide a personal guarantee to get that loan done. And the reason why, in large part, is because of the cash flow. When you actually model out, and that's what we kind of do in the step one, when someone's thinking about an ESOP, we like to do a feasibility analysis. And part of that is kind of modeling out what the cash flows of the business are going to be, using reasonable assumptions on, that they've made on projected growth. The cash flows in an ESOP company are so much better than a taxable company because of that S Corp thing I talked about, because of the deductions to pay the debt, that most lenders recognize that, and they're willing to provide debt financing on much more favorable terms than you typically get if you were trying to raise debt for other purposes. Like one way thing you can do, right? You can do what's called a dividend recap, where we borrow $2 million from a bank, and that's just used basically to pay a dividend to the shareholders. Usually, unless you have assets like enough AR to cover that, usually you have to provide a personal guarantee for that. If you're doing the same thing in an ESOP, you usually will not have to. Now, I say that, and I'm also going to say The world is really weird right now. As you know, we're having an online presentation in the world of COVID because we can't get together in person. And COVID has really messed with the debt markets right now. It's much, much harder to get debt for transactions than it used to be. We're still getting it, but we are seeing more banks ask for, not get, but ask for personal guarantees. And if that trend continues, it could change the market. Debt's a little tighter right now. It's cheaper than it was before, but it's also a little tighter. So COVID is unique. We're still working through that. So I do give that as one caveat on that question. So typical ESOP takes about 6 months from the day you think you might want to do it until you close it. It could take even a little longer than that if you want to slow walk it. And sometimes you really do. Sometimes we'll spend, and we did this with Clayton and Ritu, we spent a lot longer thinking through, right? Because we modeled so many different scenarios. And we were working with 23 engineers. It was not easy. Everyone wanted to understand it. And sometimes that takes a little while. And that's okay, right? You want to make sure that when you're making a decision, you're making an informed decision, and you're making a decision that's right for your firm, that's right for your culture, and right for your stakeholders. So spend the time and the energy to get it right up front, and then the rest of this flows more smoothly, would be my recommendation.
And Ed, we did have the extra month where we were explaining to everybody why the ESOP was better when they all said, no, absolutely not.
Right.
And I tell everyone, honestly, we did a shareholder vote, and we had 100% of the shareholders voted to go ESOP after the month of explanation.
Yeah. So there's a little case study we have in here. I'm not going to read through this. We've already talked about this in many cases, but there's a case study about what Ritu went through, right? It was a 30% ESOP. They sold the other 70% to the ESOP. We pulled in one of their affiliated entities into the structure. And again, if you ask for a copy, you can read it. Another kind of big name in the ESOP space, in the engineering science, Pannoni. So they're a fairly large ESOP-owned company that we again structured their transaction for. So those are just some of the case studies that you can read about in here. This is a non-AEC firm that we did a transaction for a couple of years ago, where we did a minority transaction initially. So we've talked about a lot of the benefits. I want to very briefly, we've got about 10, 12 minutes left, very briefly highlight economically some of the tax benefits, one of which I haven't talked about at all, which is we've talked about from the company's perspective, you get some tax benefits. There can be, if it's worthwhile and there's enough value, some shareholder level tax benefits in actually selling to the ESOP. And it's what we call a 1042 transaction, because that's the section of the tax code this is based on. There's a lot of rules. It's more complex. It can be more expensive to get the transaction done. But if the numbers make sense, you can take advantage of this. And it's very deal specific. But it effectively permits the selling shareholder to not pay capital gain at the time they sell the stock to the ESOP. It's fairly common for AEC firms, when we're doing a partial transaction first, we'll structure it like this. And then after 4 or 5 years, after they've been a C Corp for a couple of years, because you have to be a C Corp in order to do this, we'll convert them to the S Corp. We'll finish the ESOP transaction, then convert them to the S Corp. So you can kind of get the best of both worlds, get the shareholder benefits, but also get the company's benefits of having an S Corporation when we're done. So I won't dig into the details here. Just keep that in the back of your mind. It can be very valuable for some shareholders. This just talks about some of those rules you have to meet in order to take advantage of that. This gives you some.
Ed, if I could jump another question
Sure.
in that came in. Can an ESOP work for companies with only 10 to 15 employees? If so, do the costs outweigh the benefits of the transaction?
Good question. Maybe. Fact specific. It's going to depend really at the end of the day on how profitable that business is. Here's our general rule of thumb. If an ESOP owns less than, or if the value of the business, full value of the enterprise is say less than $3 to $4 million, an ESOP probably is not going to be a good fit for the firm, because the costs in setting it up, the costs in administering it are not going to be outweighed by the tax benefits. So that's one economic way to think of it. Another thing is, if you get below 20 employees, is kind of a magic threshold. If you get below 20 employees, what can happen is it makes it very hard to pass a special test the IRS makes us pass to make sure that we're not using the ESOP as a way to avoid paying taxes. They want it to be a broad-based benefit. And so that threshold is somewhere around 20 to 25 employees. If you get smaller than that, it doesn't mean you can't do it. It just means we have to look very closely at whether we can pass this test. And if not, we need to educate you and explain on what it's going to look like not getting the tax benefits. But I generally think of if your firm is worth, say, less than $4 million, probably not the best solution. Might be worth looking at, but probably the answer is going to be another solution would make more sense. So this just shows the economic value on this slide of being able to deduct the cost of paying that debt. So this is a real life example we work on. A company was worth $16 million. By them being able to get a deduction for $3.5 million of those debt payments over the life of that loan, 10 years in this case, the effective cost, even after adding in the administration expenses, is a huge savings of about $3 million in the case of this company. S corporation we talked about already, so I'm not going to talk about that anymore. But by getting a tax shield in place, you're able to generate a lot more free cash flow, which is again why banks tend to like to loan money to ESOP companies and why they like to do it without needing personal guarantees. So it can save a lot of money. This is a good example. If you have a company that's generating, this is a big one, right? But if you have a company generating $10 million of taxable income a year, they're going to pay out about $3 million of that every year, a little over $3 million in a form of taxes. In this case, that company retains it all. That can be used to pay your management team. It can be used to pay your other shareholders. It can be used for recruiting purposes. It can be used to acquire, some competitors you want to take out of the market. It can be used for organic growth to grow into new markets or new lines of business that you're not currently in. So those are all the benefits you get by getting that excess cash flow that you can use to help grow. Another case study you can read about. I'm going to very briefly now touch on some of the benefits to the company. These are studies that have been done by, I think it was the NCEO, which is a third party nonprofit organization that does research around ESOPs. And they basically find, in part because of taxes, but they grow faster, right? Their productivity is higher. They tend to have faster job growth. They tend to increase sales more than their peers. So those are just some of the things. And if you want, the data for this, it's all at the NCEO website. So we've talked about a lot of positives. I want to very briefly touch on some of the negatives. So there is this requirement that every year you need to get an annual valuation done. The other one is what we call repurchase obligations. So now that we've created the ESOP, at some point in time, your employees, and they don't all do it in 1 year, but over time, slowly your employees will start retiring. They will start moving on into their retirement years, and they have this stock that's stuck in the ESOP. And the question is, how do they get paid for the value of that stock? We call that repurchase obligation. So what needs to happen is that you need to be able to generate cash in the future to be able to satisfy those repurchase obligations. But as we talked about a couple slides ago, there's a lot of free cash flow in ESOP companies that are set up. So the idea is you take some of those savings, you don't need even close to all of them, but you take some of those savings, set them aside so you can start using it to refund that repurchase obligation once you're done paying the bank and the sellers back for their debt. There's unique rules. It's a regulated environment. Both the IRS and the Department of Labor oversee ESOPs, and that brings with it unique fiduciary issues, a lot of rules and regulations that need to be followed. So you want to make sure if you're doing this, you're working with a very good ESOP advisor who can help you navigate those things so that you don't trip over some rule inadvertently that you're not aware of. There's weird accounting rules. Again, the banks generally understand these, but your accounting firm is going to have to get up to speed on what that means from your own financial statements. And for construction firms, that's particularly important because if you have any bonded projects that you need to work on, your balance sheet is going to look really weird when you're done with an ESOP transaction. So you want to talk to your surety companies really early in the process to get them on board so you can get them up to speed on what that looks like. Other things you want to think about are your employees get to vote on certain things, not everything, but certain things they're allowed to vote on. So that's one of those things they're not allowed to do right now, right? If you're not an ESOP company, but you might need to in the future. You have these rights to diversification in the future. I don't have it on the slide, but we talked about earlier that, the licensing issues around, especially architects and engineers, we got to make sure that we satisfy those rules, even if we're going to have some ESOP ownership in place, which is very state specific. Harder to sell ESOP companies in the future than non-ESOP companies. Harder is probably too strong. It's different. And so you need to make sure that you're cognizant of that. But it's done all the time. In fact, today we're working with a company that we're selling to a private equity firm, believe it or not, large ESOP company that we're selling. So we do them all the time. Just got to be cognizant about it. From an employee perspective, a few benefits. they're less likely to close. This study was done actually during the 08-09 downturn when, you know, debt got very tight and a lot of companies failed. ESOP companies were less likely to close during a recession. There's also less turnover during those recessions, 4 times less likely to be laid off. This statistic here is kind of mind-boggling, but that is not a typo. It is absolutely true. Because the value of ESOP companies can get so large based on the fact that you have all of these tax savings, the retirement value between their ESOP and 401k for ESOP companies, when you look at the value of those accounts, 2.5 times greater than comparable non-ESOP companies. Really, really, really valuable for your employees over time. And employees of ESOP companies tend to earn a little more money again because of some of those tax benefits. So those are some of the benefits. Again, you can find all of that on the NCEO website.
Ed, question just quick came in saying, what is the seller's motivation for the transaction you mentioned, specifically the ESOP seller to a private equity?
Oh, sure. Yeah. So the one I'm working on now that is actually closing today, their situation was that they did a bad job of management succession at the end of the day. And that happens sometimes, right? You can get that in any company, and it can happen with ESOP companies as well. But, you know, you created this ESOP that was valuable for the seller. Over time, it was valuable for the employees, but then you get down the road 15 years later, and the management team that ran that company for that 15 to 20 years, either because they couldn't find the good next generation to take over the management, or because they just didn't focus on it. It wasn't a priority for them, but now you have a management team that's kind of ready to move on, and there's no one there left to run the business when they move on. And so in that case, what they decided to do was to go ahead and go out and sell to private equity, and it was the right solution for them. What that usually means is that they have to agree to be around a couple years post that transaction so that the private equity firm can make sure that the business has continuity for a couple years as they slowly then change that management team out. So that's what drove that transaction. I would tell you, more often than not, that tends to be the reason we see them sold. A lot of ESOP companies, though, will continue to be ESOP companies for an extended period of time. We have a client out in Western Pennsylvania they're a manufacturer, so different industry, obviously, but they've been an ESOP company for 46 years now, 47 years, so very long time. So you can, the idea is if you do it right, you can have a long-term sustainable ESOP structure that is able to self-perpetuate itself through multiple generations of management if you do it right. So this slide just gives you some considerations we look at. You know, I talked about some of these already. We want, 20 to 25 is kind of a rule of thumb on size as far as number of employees. You want to make sure it's a company that is at least profitable on some level. If you're not generating some stable cash flows, some profitability, throwing an ESOP into the mix is probably not going to be a long-term solution. For some A&E firms, what we find is that may require some changes to compensation, right? You might have a couple of founders who get large compensation that may be in excess of what market compensation is. So we may need to, in order to make the ESOP work, level set their compensation to facilitate an ownership transition change. That's one of those things we'll work through sometimes in our modeling to help A&E firms manage an ESOP succession. So that's basically it. Kind of rushed through some of the tax benefits there, but really the purpose wasn't to make sure you fully understood them, but at least to get a baseline level of comprehension so that you can dig into this in more detail if you decide to look at it any further. Clayton, what have I missed? Anything else from your perspective that you think is worth throwing out for the audience?
Wow, honestly, if you're considering an ESOP, really want to reach out to someone and go through what Ed went through, but in a little less speed. He threw a lot at you there, but it's really, Ritu has seen it as a very, very positive step for us. Several of my friends that run other firms that are ESOP, they've really quote unquote drank the Kool-Aid, and they've talked to me about how exciting that their firms are now because they've taken that step and the different ways that they get to manage it. However, like Ed said, it never changed our management team at all. We have virtually the same board, except we decided to add 2 external board members, and the entire management team is the same. So companies being run exactly the same. We're just now 100% ESOP.
Excellent. Well, thank you, Clayton, for joining us today. Thank you all for participating virtually. We really appreciate asking questions. It's always easier for us when you're asking questions. And if you have any other, my email address is it was in the chat, but you can find me online as well. I'm more than happy to send you the presentation or answer any other questions you have. I hope you all have a very good day. I'll turn it back over to Olivia now.
Yeah, thank you so much, Ed. Great presentation today, and thank you, Clayton, for joining us and helping kind of moderate those questions. Thank you, everyone, for joining, and I will be sending out Ed's contact information in the follow-up email along with the certificate of completion and the link to submit your AIA credit if you are an AIA member. And that will be coming tomorrow. And thank you, everyone, again. And thanks, team.
Thanks, everyone.
Take care. Bye-bye.
Have a great rest of your day.